called Managed Portfolios. And so I'll go through what went well for our portfolios in 2023 and what are we looking at in 2024. So thanks for joining. And if you are a new client, this would be a good session for you to get a brief overview of our managed portfolio. And if you're existing clients, you should know that our portfolios have managed to capture the market recovery in 2023 and entering into 2024 has been pretty decent year and good performance for us as well. So let's dive into the next slides. So I think I will just give a brief overview of the global market performance first, so that everybody have, if you're not tracking the market, you can actually get a refresh of your memory, what happened over the past few years. So this is what the slide is going to show you. So this is the price performance of three big key indexes. So since the pre-COVID levels, so as everybody knows, COVID, this is the COVID low, and since COVID started and we had a rally, and then in 2023 here, most of the key major markets also had a correction, and of course we had a rally as well since the low in 2022. So these three lines here, you can see the first line. I'll talk about the world index, which is the blue line. So what the blue line show you here is that the recovery actually has been pretty amazing. So you can see that the recent recovery since 2022 low here. And I think I would like to refresh everyone's memory. It was that 2 years ago, there were a lot of fears in the market. Like people talking about recession and high inflation and monetary tightening and war and whatsoever. And it got people very scared of investing in the market. And that actually understandable. But when things get cheaper, it creates a very attractive environment for investors who know where to put their money. So the world index, the blue line, actually did a very good recovery since 2022 low. And this is a price chart up until December of last year. So here is the recovery here. And what drove this recovery over the past 1.5 years for the world index, right? So world index, you have a lot of developed markets in it, right? So of course, the corporate earnings has been better than expected. Then we have this AI rally. We also have this, the last rate hike it was about, for US at least, it was July last year. So it has been quite a while already. So we actually coming from a tightening cycle and rate hike cycle to now is a pausing cycle. And a lot of commentaries and even the US Federal Reserve are saying that they will cut rate. So they are expecting 3 rate cuts this year. So it's a different environment altogether. So of course, with all these positivities, of course, market react positively to it, at least the world index. So I was saying that it's very important to know where to invest, in a sense that if you look at China, right? So if you're in China, if you're in China, your portfolios actually would not be doing as well. So you can see China actually been lagging behind this orange line here. So what we want to show here is that we really need to know like where to put our money, not just about investing, but where to invest, right? So this is so next slide, we're going to show you our performance. So if you look at our performance, this is our conventional historical performance for our conventional portfolios. So we have 5 portfolios. So let me just briefly describe about this chart. So this is historical performance since inception of our portfolios. So since inception, numbers here, total performance, and so inception was 2017 May. So 2017, 2018 performance, 2019, 2020, 2021, 2022, 2023 last year, and year to date for the first 2 months of this year. So A is aggressive portfolio, MA is moderately aggressive, B is balanced, MC is moderately conservative portfolio, and C is our conservative portfolio. So we have 5 portfolios for our conventional mandate. So you can see that the performance for the first 2 months of this year actually pretty encouraging. Year to date, our aggressive portfolio is up 7.4%. Even our conservative portfolio is up 2%. And if you look at last year, 2023, our aggressive portfolio up 15%, whereas our conservative portfolio was up 8%. So these are very encouraging numbers because think so. You look at 2022, right? Most markets actually suffered. So that's why our portfolios got impacted as well because we stay invested all the time, right? So, but what is more important is that are we able to capture the recovery and pick the right place to ride on the recovery? So we did. So that's why you see a very good performance in 2023 and year to date, right? So moving on, this is our Islamic portfolios performance. Same thing, we have 5 portfolios, 5 risk profile for this Islamic segment. So our Islamic portfolio incepted later in 2019. So you can see that it's the same thing. 2023, our aggressive portfolio returned 17%. Even our conservative portfolio is up 7.9%. And if you look at year to date, it's similarly very positive kind of numbers. So aggressive portfolio is up 8.6% and conservative is up 1.9%. This is only for 2 months of this year up until end of February. So very important that you also I would also like everyone to just take a step back and look at this performance since inception, right? So if you ride through with us, you actually would go through more up years than down years. So we only had like 1 down year for Islamic portfolio. So most of the time we had an up year. So the same thing for our conventional portfolios. We only had 2 down years. These 2 down years in 2018 and 2022, it was because most of the major markets were down as well. But when the market recovered, we managed to pick the right segment to ride on the recovery. So that's very important. How do we manage to pick the right segment and how do we squeeze performance right? So mainly performance from 3 key areas that is like our day-to-day job. It's like we look at these 3 key segments very on a daily basis. So first thing is on asset allocation. So we are overweighting equities, so we put more money into equities. So when equities rally much more than bonds, so that is where our portfolios would benefit much more. So we rightly position more into equities. So that has helped our performance. And secondly is on this, you can see this world map. So basically is to know where to put more money, which country to put more money, which segment to put more money. So I will just share that rightly we have overweighted Japan. We also have a strategic allocation into the global technology segment and especially semicons. So these areas have really helped us a lot in terms of putting more money into places that rally a lot, right? So then the third segment is the fund selection segment. So knowing which country, which segment to invest is important, but knowing which funds to buy is also very, very important because some funds will underperform, some funds might not, even in the same country, but perform less than expected. So, so how we do fund selection or what ETF selection, we look at 2 things: quantitative analysis, qualitative analysis, the past performance, historical performance, but not just that, but also the cost, and also we meet with the fund managers and to know their strategies, whether their strategies are in line with ours, our house view. So that is how we combine everything to generate performance, right? So let me move on to something more. What really happened in 2023, right? Exactly go through the start of the year until end of last month, right? End of February. So when we enter the year 2023, right? What we did was that December 2022, we actually reduced China exposure. We also reduced our China technology exposure, as you can see the blue box here. And we moved the allocation by increasing in US, Japan, and Malaysia. So we actually, for Malaysia, we increased in Malaysia small cap, which has done very, very well. As you know, US and Japan also have done very well since the start of last year. So that has actually helped our portfolio a lot. And if you see another green box here, September last year, we further reduced our China exposure to a very minimal amount. And then we further increased our overweight in Japan. And we actually increased further increase our US exposure. And not just that, we actually replace our Hong Kong tech with Globee Semicon. So it has greatly contributed to our performance. As you can see, December here, almost the low here, and then after that it was just like almost a straight line up, right? So, but if you just zoom out from the start of last year until end of last year was an amazing year for us actually. So, so this is the price performance chart of our aggressive conventional portfolio, right? So, those are the green box. The green boxes are what we say what it is the asset allocation changes. So we decide where to put more money into which country or which segment. But to contribute to our performance, it's not just that, but also fund selection. So you can see the orange boxes right here, like 4 orange boxes here. Those are fund changes. So which means that at some point in time, like in June or August or November or February, we decided to switch fund because there are a lot of reasons why we want to switch fund, right? So I'll just give you an example next on why we want to switch fund. But before that, I also want to highlight that very happy to highlight to everybody that we actually been slowly adding ETF into our portfolio. So you can see September here. So we actually added ETF into our portfolio, first ETF into our portfolio. So that is actually our Semicon ETF. Yeah. And then we this year, 2024, we continue to add another ETF, which is, I'll show you later what's the ETF, and we'll talk more about this later. But let's delve into the fund changes, right? So a lot of reasons to change funds, and I'll go through one key reason. So this is one key reason why we make fund changes in 2023 for one of the fund changes is that I think everybody knows about Country Garden, right? So knowing Country Garden is just not enough, but we also need to know that what in our portfolios, which funds are exposed to Country Garden. So that is what we do at our firm, is that we analyze, we have our system to check what kind of which funds would have exposure to it. So this is the article that written by our research team, and not just for our internal consumption, but we also write it out for individual investors. But the thing is that how often individual investors would read articles, right? But for us is that because we are this is our daily job, right? So then when we know this kind of news, when we analyze the company, and then we found that we are not comfortable with the Country Garden papers in the bond funds, then we take action. So we actually took action to change. So we before the write down of Country Garden bond papers, we actually removed the fund that have exposure with funds that have no exposure. So this actually helped us to avoid losses. So basically, we kind of mitigated or avoided the Country Garden pain, right? So that actually benefited our investors as well. So that actually reflect in our performance, which is you can see the performance actually quite decent, even for our conservative portfolio, right? And so this is one of the many reasons why we do fund changes. Yeah, there are a lot more reasons, but because of time constraint, I'll just talk about one. Yeah, and then moving on into the asset allocation, right? So currently, so just now I was talking about 2023, what we did, but in 2024, what is our current allocation, right? So currently, if you look at the table on the left here, we are still overweighting equities by 5%. So as you know, the equity market continued to rally beginning of this year until now. So that's why our portfolio is benefiting from this more money in equities. And I think the other reason here is if you look at the right table here, especially the equity allocation, you can see that we actually overweighting Japan by 4.5%. So currently, our portfolios have, in a neutral basis, we have 9.5% in Japan, and this is the one segment that we're overweighting, and the other segment here is the technology segment. So this is the strategic allocation that we have for technology. So 5% in global tech and 5% in semicon. Yeah. So because of time constraint, I'll focus on why we overweight Japan and also why do we have strategically positioned in global tech and semicon, yeah, which has benefited our portfolios a lot. And I think the other part that I want to highlight is that our China exposure is actually very small. It's on a neutral basis, it's 3.5%, and we are underweighting the benchmark of 5%. So basically, the positioning has been pretty amazing for us. Yeah. And so just a brief uh, elaboration on why we overweighting Japan. So this is just a brief one. And the one thing about Japan is that there has been a very positive structural changes that has happened to Japan for many years. So, and especially recently, it has become more obvious. So what happened is on the corporate governance reform. So corporate governance reform is basically when it's positive, it means it's good for investors, good for shareholders. So then if you are investors, you will be happy to be investing in Japan. And why, right? So you can see actually the structural reform didn't start recently. It started actually in 2015. It was something that brought out by the late Prime Minister Shinzo Abe. So he's the first one to he's the one who introduced the first corporate governance code back in 2015. And so over the years, what happened was that since then, you can see that there are more independent directors on the Japan corporation. So this is the total independent directors that is on the Japan corporates. So it has been rising. It's on a rising trend. Right. So, and more recently, what happened was that in 2023, there was a guidance from the Tokyo Stock Exchange requesting the listed Japanese company to be more investor friendly in the sense that wants them to improve the corporate value. So how do you improve corporate value? Means that you need to be paying dividends, that's one, and also think about ways to improve your share price, right? So yeah, so that is actually a key thing in Japan. And so this is I guess this is something also attracted a lot of global investors like Warren Buffett also started investing in Japan, right? So that has actually drawn a lot of attention. Yeah. And these things are actually very structural for Japan. It's not something like a one-off kind of thing, but it has been there for quite a while. And then if you look at the next point for Japan is that it's on inflation. Actually, inflation, a lot of countries, inflation has been bad for, it's a bad news for a lot of countries, but not Japan. Because Japan has been trying very, very hard for many years to bring in more inflation because there's actually suffered from low inflation environment for many years. So a bit more inflation is actually good for Japan and they're actually very happy about it. So that is actually one key positive that the Japan is very happy with. So so that are the two key points. And there are many other key points, but time constraint, I'll just stop here. And we still see, in terms of target price for Japan, we still see some upside on Japan equities. So so that's why you can see that why we are still overweighting Japan. Yeah. Uh, so, and moving on into global semicons. So global technology and semicons, I think everybody knows about this, but let's look at the short-term kind of, look at short-term, right? So this chart, it shows you the projection of NVIDIA's revenue on your left for the next, for this year, for the next 2 years, you can see it's an uptrend, right? So on a short-term perspective, you can see that it's a very clear visibility in terms of the revenue trajectory. And the chart on your right, you can see the earnings growth for the semiconductor sector, not just NVIDIA. It's also an uptrend in terms of you look at the earnings, the blue color is the historical numbers, and the green bar here is the projection for the next for this year and next 2 years. So it's on an uptrend, right? So this is a short-term kind of trajectory, but as an investors, we also want to know about the long term, right? Is it sustainable or not, right? So if you look at the long term, right, if you look at the NVIDIA ecosystem, this is exactly captured from NVIDIA, looking at the whole AI ecosystem that we've been talking about. So actually, we are still in the early phase, but very important also is that in the AI ecosystem, it's not just NVIDIA that will be benefiting. It's not just hardware, it's not just NVIDIA's chip, but it's actually a lot other more companies and segments that would benefit from this whole AI kind of development. So you can see on your, let's start from the left here, right? So Accenture, all these guys, Deloitte, Infosys, TCS, all these are the IT consultants, right? So not everybody can just go to NVIDIA and just buy the chip, and because it's just an hardware, but you still need someone to advise you how to structure the whole entire hardware and how and all the stuff to make it work, right? Not just the hardware itself. So then you have the AI platforms. These are Databricks, Snowflake, all these guys. And then of course here you have the data centers guys. So now I think more attention is on these data center guys, that they are actually revamping their or upgrading their data centers. So AWS, Google Cloud, Microsoft Azure, Oracle, these guys. But also very important is that don't forget about the software guys, right? Also very important in the AI application. So you also have private cloud and the OEMs, right? Other OEMs that helps you to fix everything together. So this is just a brief view of the ecosystem. But then on the other hand, if you look into the industry that at least NVIDIA is talking about now, or the semicons or the tech companies are talking about now, is, so firstly you look at this part right here. So this one, hospitals. So talking about biotech, how AI is going to accelerate drugs development, discovery, and then you have here the industrials, how to do all more automation to improve efficiencies, productivities. Then here you can see here is on the telcos, mobile wireless companies, and then you have robotics here. This one is your data centers. Then, of course, not forgetting the EVs, right? I mean, we heard about Tesla, talking about buying chips and try to improve, because it's all about data, and you need actually very strong, very powerful chips to do a lot of programmings and um, to generate those kind of data and make use of the data, right? So this is on the semicons. So the long-term trajectory is still very positive. A lot of developments there. So we have a short-term and long-term kind of very positive impact. Yeah. And so those are just early on is just to focus on these few segments that we are very positive in. And now moving on into the fund selection, right? So like I mentioned earlier on, fund selection is also a key part, not just about knowing which country or which segment to invest, but also knowing what funds we want to represent for each segments or each countries. So you can see here is that uh, you can see here the two ETF funds that the two ETF that I was talking about earlier on that we added. So we first added semicons, SMH here. And then this year, we actually added our JP Morgan US Quality Factor ETF. And very important is that we do not want to simply just add ETF. We only want to add ETF when we think that is much better for our portfolios, our investors. So I don't know. I mean, if you want to create a full ETF portfolios, we can always do that, but that might come into expense of performance or whatsoever. So whatever that we include into our portfolios is to make sure that it adds extra benefits to our investors and our performance. So and we are trying very hard to keep on looking for better options for our investors. Yeah. So this is the list of the funds that is in our conventional portfolios. So it's after our two major pillars and building blocks in selecting the funds. So one thing is mentioned earlier, quantitative analysis. We look at the past track record, expense ratios, how resilient the fund is. Basically, this is reflecting of the fund house or the fund managers, how good they have been running the fund. And not just that, not just based on historical numbers, but also we want to be more forward-looking in terms of having meetings with the fund managers, know their strategies, get their insights, and then compared to ours, see whether it's in line with ours, then only we start implementing the fund into the portfolio. Right. So important to have good fund selections process. So, so as for investors for you, is that if you want some updates from us, of course we do this kind of webinar once in a while. But on top of that, we also write our monthly and quarterly commentary. So you can see here, this is I show here is our quarterly commentary. So we've been writing it every quarter. So you can see fourth quarter 2022, first Q 2023, 2Q23. So this is the webinar that I had late last year. So and then we also 3Q 2023, 4Q also we released last month. So if you need more information, we do write all this monthly and quarterly commentary on our platform. If you do not know where to get it, do contact our client investment specialist so they will guide you in terms of where to look for it. So it's all on our website. Yeah. And not just that, not just Zoom, not just articles, but we also do events, right? So we will be in all the major events of FSM1. So we'll be there, and do come to our events and look for us, and we will explain to you on our portfolios, any inquiries you have, right? So do come, and then I think what I want to conclude here is that we have 5 different risk profile portfolios for conventional. We have 5 different risk profile for Islamic portfolios. So you can pick portfolios that match your risk profile, right? So if you are someone who is more aggressive, if you think that you like the current market recovery and you can take more risks in terms of to go through this market rally, then probably can take on more aggressive portfolios. But if you are someone who very afraid of losses, that kind of risk profile, then of course you go for more conservative portfolio. But do engage if you don't know. But if you don't know which to pick, do engage with us so that our team can assist you, right? And just to summarize, is that so our job here is to help you to generate performance. How do we do that? Is by asset allocation. So whether we want to put, like the first point here, whether we want to put more money into equities or we want to put more monies into bonds. So that is something that we will decide. And the second point, also very important, is that which country or which segment we want to put more money. So thank God we have generated very good performance by being right in terms of asset allocation, being more equities and more into Japan, more into semicons, global type that have benefited everyone. And actually, not to forget is fund selection, the third point. And this fund selection, as you can see early on, we have done a lot of fund changes over the past 1 year. So we don't do this kind of fund changes when it's not needed. So when we do it, it was because it was so necessary that we need to do it. So and it has actually benefited our performance and defended our performance. So so these are the things that we are doing for clients. So and clients like you, what you need to do is just select your risk profile, right? Yeah. So just a summary is that just what we want to share is that do go through with us over the long term, like, because what we understand is that when things get cheaper, investors do not know where to invest, and investors feel worried, not sure whether they are picking the right fund, not sure whether they are picking the right segment, not sure whether they are picking the right country. But what you can be assured of is that our portfolios, we have a team. So not just Malaysia team, we actually have a lot of we actually have few operations outside in the regions, and we share our informations, and then we come to a conclusion in terms of the selections where to put money. And you should be rest assured that from our performance, we will help do our best for our clients. So which also reflected in our performance over since inception, right? So you can see this is our conventional performance. We only had 2 down years, and the 2 down years in 2018 and 2022, it was because most of the markets were down, right? You really can't escape from that. But what is very important is that the recovery after that, which we managed to capture. So you can see 2019, the recovery, and it actually extended for a few years in 2020 and 2021. So we also had the recovery on 2023, right? So the reason I'm being long-winded on this is because it's so important that uh, we are able to write on recoveries when certain markets did recover, right? So very important. And I think the next, yeah, this is probably my last slide already. So this slides, Islamic portfolios is the same thing. If you are Muslim clients, you can consider our Islamic portfolio. The performance has been amazing as well. So especially our conservative portfolios, which has done very, very well. Rather than saving in FD, can consider our more conservative portfolios. Like since inception, return 25%, right, over the past 4 5 years, right. So I think that's it for my presentation today. So I think I will just take questions. If you have any questions, yeah, I think there are a lot of questions. So let me just go through one by one. The returns you show, right? Have you account all fees related to the fund? Yeah. So this so the returns that I show here, it has not included the annual management fee that we charge. So, but those are very minimal amount. So even if you include it, it's actually super minimal. Is from my perspective, is a very small price to pay to get a peace of mind, someone that's managing for you in terms of your portfolio. But you can do call us if you have any more questions on the fee side. Yeah. And when is the best? Let me just repeat the question. When is the best time to invest in the managed portfolio? What is the best strategy to top up the fund? Yeah. I think if you're asking these questions means if you have regular income on a monthly basis, yeah, you can do that in terms of RSP, top up every month. But what I would suggest is that also when market gets more attractive, right? When you see this kind of correction, you should actually get more excited to pump in more money if you have, right? So when markets get cheaper, you shouldn't be too fearful. Yeah. So I think that is what I would share. Yeah. If you appreciation of yen may affect export, would this affect the Japanese market? Yeah. So early on, I shared that yen is actually just one factor. There are actually a lot more factors that is positive for yen. So like I talk about this corporate governance reforms, right? This is actually very structural, very positive. So and yes, as an investors, you want to be sure of this. You want to be sure that the companies that you invest in actually continue to improve corporate value, right? So those kind of mentality would drive uh, profitabilities and kind of adding more value to investors. Right? Yeah, you don't want companies that actually treat investors badly. So for Japan, the whole culture has changed in terms of the corporate culture. And also Japan, also you can see a lot of actually developments in terms of they are building their new, they are building a lot of, they're getting more involved in the chips manufacturing segment. Yeah. And the other thing about Japan is that inflation, right? Inflation, like I talk about, is one key thing for Japan, which they wanted inflation so much for so many years, and now they're getting it, which is will be positive for growth. So yen would be just one key factor. Yeah. But based on our target price, our in-house research target price, we still see quite some upside for Japan equities. No updates on Islamic portfolio. I'm investing on that portfolio though. Yeah, okay, so I'm so sorry because of time constraints, so I just talk more about conventional portfolios, right? But our conventional portfolio and Islamic portfolio, in terms of allocation, right? Like equities is the same thing. We overweight equities. So the way we look at as a location, right? There's no difference in terms of which portfolio. It's all following the same allocation. It's just on fund selection. We want to make sure that so allocation is it will be the same. We underweight China and we overweight in terms of the developed markets, right? Unfortunately, for Islamic portfolio, there's no specific Japan Sharia fund. So unfortunate, but that's fine because our Islamic portfolio actually also benefiting a lot from the global semicons, the global tech segment, and also the developed market rally. So you can see that your Islamic portfolio actually doing very, very well, right? So you also underweight China, so it's the same allocation. It's the same kind of formula that we are implementing, right? And in terms of fund selection, of course, fund selection is very different because for Islamic portfolio, we make sure that all the funds inside is Sharia compliant. So you can see this ETF, right? This, if we go through this semicon ETF, SMH, it's actually not Sharia compliance. That's why you don't see this ETF in your Sharia portfolio. But we make sure that there's good enough semicon fund that can represent, which has benefited the portfolio. Even though it's not ETF, but it's a very good fund that that managed to capture this semicon rally. So rest assured, that's why you can see your Sharia portfolios doing very, very well. You look at 2023, right? Your aggressive portfolio actually returned for 17%, and year to date, your return is 8.6%. That is amazing, I would say. So, so that is for Sharia. If anything more on Sharia Islamic portfolios, can just call us. I'll be happy to take on more questions. So, do you foresee a recession coming in 2024? What is your strategy to manage the investment during recession? Yeah, so I think what happens now is that we still see very positive developments for this current rally. So of course, when times comes for us to change our strategy, we will evaluate, then we will reflect in our portfolios accordingly. Yeah, but of course, for now, we will still ride on this current rally. Yeah. So that's why you can see that we are still very positive in terms of overweighting equities as of now. Yeah. So does Islamic aggressive perform better than normal aggressive portfolio profile historically? This is a very good question. So if you look at 2020, if you look at recently, right, the Islamic portfolios has performed much better. It's still at 17%, 2023, 8.6% year to date, right? If you look back at conventional actually did slightly lower. And the key reason is because of in the Islamic universe, right, the investment universe, there are a lot of the tech companies, right? And also there were very little of so Islamic universe, there's no financial sector. So what has been rallying over the past 1 to 2 years actually has been, a lot due to technology sector that has been rallying a lot. So that has actually benefiting the Islamic portfolio, right? And yeah, so that's the key reason. And I think the other reason also is that Islamic principle. So if you know about Islamic principle, right, is that it actually will eliminate all those very highly geared companies, companies that had companies that got a lot of debt, that is not that profitable, or yeah. So as you know, all the past 1 to 2 years, right, the companies that have been rallying a lot, right, are those high quality companies, right, which really gel with the Islamic principle, which in turn is benefiting the Islamic principles of investing. So so that's why you can see why Islamic portfolios are generally do better, right? And I think last point is that Islamic portfolios And Universe has a lot of exposure in South Korea and also Taiwan. So as you know, year to date, South Korea and Taiwan has done much better than a lot of other Asian countries. So you can see, let me just go through here. Yeah, so in 2023, right, you can see that um, Asia, Japan up 8%, and yeah, I don't have Taiwan and South Korea here, but basically Taiwan and South Korea have done much more than 8% in Asia and Japan. Yeah. So that's one key thing. Yeah. So basically three key points why Islamic portfolios have done much better over the past at least 1.5 years. But historically speaking, it really depends on what kind of environment we are in. Yeah. So next question is, average return for aggressive portfolio is around 5% for the past 7 years. Is this in line with the target for aggressive portfolio? Yep, very sharp, but it's not 5%. So it's about 6-7% now. So as you know, is that if you invested since inception, so um, if you invested since inception, you are getting about 6-7% per annum as of now. But now we are talking about a recovery period. We are not even talking about is the whole world index is rallying much more than uh, average. So we are talking about recovery period. So we had a down year here, 18%. So when we calculate performance, we need to take into account of this negative 18% in 2023. So let's say if you ask me this question in 2021, I would say that looking at 2021, 7%, 2020, 18%, 2020, 2019, 18%, and 2018, negative 11%, and 2017, it's actually up 8%. So actually, since inception until 2021, it has been pretty amazing, right? So I think why you can see a lower number now is because we need to take into account of this 2022 period that was down a lot, right? So of course, the longer you hold, as the market goes up higher, of course, the average performance should move up as well together with the market, right? So it really depends on what kind of timing that you're looking at. But I think more importantly is that uh, we actually would urge and advise clients, like take opportunities of this 2022 period where market was down a lot, try to average and get more attractive prices. Because our portfolio, so very important to understand is that our portfolios, we do not raise cash. We are a fully invested portfolio. So what we can do during down market is that we protect the portfolios in terms of, so you can see that in 2022, right, actually a lot of many major markets actually were down much more than what we had suffered in 2022. And the best case is that we managed to ride on the recovery in 2023. So that is actually key in terms of long-term investing. Yeah. So yeah. And the next question is, isn't it that US semiconductor and technology valuation are very stretched? Likewise for Japan market, are these more are there more rewards over risk? Um, yeah, so I think the key questions here is about the long-term. If you look at the long-term developments and structural dynamics, it's actually very, very positive in terms of the developments. Of course, prices has gone up, but from our calculations, our research is that we still see pretty good opportunities. That's why we are still having exposure in overweight exposure in Japan and also in semicons. So yes, prices has risen, but uh, has it taken into account fully priced in or not? We don't think so from our research. Yeah. So then next question is, I love luxurious brands like LV, Hermes, Kering. can you suggest any fund that includes the above? Oh yeah, I can't talk about individual funds, but you can call our client investment specialists maybe tomorrow, so that we definitely have funds that have more exposure to these areas, the luxury brands, and they have yeah, these funds have pretty amazing funds too. Yeah, you can call us our client investment specialists. Yep. So is the next question, is the Malaysian equities expensive now compared to Singapore market? Do you think China and Hong Kong equities are cheap? If so, is there any opportunities? Yeah, so sorry. So for Malaysian equities, right? If you can just go to the fund that we have exposure through for Malaysia, it's actually a pretty amazing fund. The fund has been up every single year and it has done super well over the past few years, and that is because of we really like the fund manager strategy, and they are able to capture opportunities in the market, even in a very volatile market, right? So we are happy with the strategies, and we still want to maintain our 10% neutral exposure in Malaysian equities. Yeah, so it's very hard to compare to a Singapore market, right? So Singapore market, if you look at the big index, is very much is a different segment because our Malaysian equities is much into small cap. Yeah. So and small cap have done very well, and I think Malaysia small cap is still a bright spot in Malaysia. If you can, if you follow Malaysian news, right, is that our ministers has been focusing a lot on getting more investment into Malaysia, especially in the semicons space, the whole value chain, the semiconductor. So that will benefit our small cap a lot, right? So it's totally a different market. So our perspective is that we try to select markets that we find attractiveness. So we want to be positioned in those markets, right? So as for Singapore, Singapore is our exposure in Singapore is through our ASEAN or our Asia funds. Yeah. So we will let the fund manager to decide uh, which markets they want to be in which point of time, because our key job here is we really want to select the best fund managers, the best fund that can do the work for us, right? So China, Hong Kong equities, yes, is cheap for a reason. So we are still monitoring. So I think in short, what I can say is that we are we actually still we are still awarding Hong Kong and China equities. So as you can see, it's reflected in our allocation. So it's something that we will continue to review, but for now, we try to stay away and have uh, underweight exposure in this area. Yeah. So next question. Sorry, so it's back to performance. Sorry, it's only 6%, which is just slightly more than EPF. What is the advantage of portfolio if we cannot beat EPF? Yeah, so I think I already mentioned. So if you invest in the portfolio, like let's say the performance is right in front of us. If you invest in 2023, your performance for aggressive portfolio is 15%. Your EPF, I think recently, let's say it's 6%, is at least double your EPF performance. Like even year to date, the first 2 months, aggressive portfolio is 7.4%. It's only 2 months. So it's easily beat your EPF performance for last year, right? So it really depends on your timing of investing. The problem with investors, I would say, is that um, uh, do not get too excited when market is at the peak. You should get excited when market is at the bottom, so then you can squeeze more performance, right? So basically, our job here is to make sure that we are allocating more money into areas that can recover, right? So yep. So I think if comparing to EPF money, right, 6% is that I would say that investors who compare to EPF will feel more comfortable with EPF. I mean, it's okay because it's a different kind of risk taking, right? So EPF is very safe, super safe. So you can get 5-6% every year. I mean, historically. So I think the equity market is more for investors who want to squeeze in more performance when the market gets very exciting, very cheap. So like 2022. So that's where you can squeeze more performance. So our job here is to create an avenue for clients to feel comfortable in getting into equities. Because what we felt is that after talking to clients actually felt that when market is very cheap and correcting on a pullback phase, people do not know where to invest and don't know where to put money, right? So we are trying to create an avenue for clients to be comfortable to invest, right? When market is at attractive levels, right? Yeah. So if I'm already heavy on next questions, if I'm already heavy on China, what do I need to do now? Rebalance now or wait? So this is not advisory. We are not an advisory kind of department. We are actually a portfolio department. So I can't advise. I'm not licensed to advise you on your individual portfolios. You can actually go and you can actually go to our website and look for the contact of our client investment specialist. They are licensed to advise you on your individual portfolios. Yeah. So what we do here is that we rebalance for our portfolios that we manage, like these managed portfolios. Yeah. So what is the next question is what is your view on the bond market? Yeah, actually I don't have the slide here, but the bond market is really attractive because if you talk about okay, so let me show something that I missed out. Thanks for pointing out. If you look at our allocation, right? Yeah. So we actually have dedicated exposure in global bonds, 15%. And why is that? Is because it's really attractive. If you look at global investment grade bond index, right? It's actually back to the level is back to the 0809 crisis, right? So it's at a level that is very attractive because we are not in the 0809 crisis now. We are actually in market rally period, and most likely we already seen the peak of inflation, right? So if that's the case, then the yield that these global bonds are offering is really attractive. And even our fixed income, our Malaysia bond papers, right, also very attractive. It's actually back to pre-COVID levels, right? I'm pretty sure everybody here have logged in a lot of your FD rates at maybe 3.8 to 4 or even 4.2%, right? You guys just log in these rates. You definitely find it very attractive as compared to 2 years ago. So similarly, for bond market, it's the same thing that we find very attractive. But because why we are underweighting bonds is because we find equities much more exciting and can squeeze in more performance. So that's why we are overweighting equities by 5%. It's not that we don't like bonds. We actually like bonds. But you know, you only have 100% of your money. You need to, if you want to overweight equities, it has to come from bond, right? So that is the reasoning. So in short, we like both equities and bond. Yeah. So next question, what do you think of China in the mid to long term? China is still big countries, still a super power in the world, right? So and yeah, so we will see too. What happened to China recently was more on the China has been going through structural reform. So when you go through structural reform, of course, there would be short-term impacts, right? So of course, what we are monitoring now is that whether we can see better sign in terms of whether uh, it would encourage us to turn positive on China. But as of now, we are we are avoiding China. Yeah. But I think we still have to monitor in terms of what happened to China in the mid to long term. Yeah. we need to go through this phase first. Like this is the reforms phase, right? A lot of changes happening in China. Yeah. So there's still a lot of moving parts that I think nobody would be sure of. So next question. Islamic portfolio kind of better than conservative? I think the question is Islamic portfolio is better than conventional portfolio in terms of return. Any specific explanation? I've already explained this earlier on. I think I just quickly just touch on the three key points. I think one key point is the investment universe um, in Islamic universe is that there are a lot of technology companies and very few companies in China, and also a lot of uh, exposure in Taiwan and South Korea, which have these two key markets have done very well. So that's why Islamic portfolios has benefited a lot. Right. So next question. Thanks for the informative sharing. Just curious, China stocks were in trend 1 or 2 years ago. Any reason why is not making well? Yeah, actually, China has been not doing well for the past at least 3 years, 3 4 years. Um, the reason why it's not doing well is because China is going through. I just briefly go through. So one of the key segments, which is property, has been a key driver for Chinese economy. So what happens is that Chinese government realized that the property they cannot forever rely on the property market, and they need to do something about it to stop the craziness going on in property market. So what happened is that since 10, 20 years ago, right, how the Chinese citizens make money or feel comfortable parking their money is that it's almost like a rest assured thing to buy properties and make money from it. So it's almost like a guarantee kind of returns by investing in properties. So this is actually shouldn't be the case. And there are a lot of investment investment, people buying properties for investment. But there was a change in perspective, and the government doesn't want this craziness going on in the property market because the property prices in China is really extremely uh, expensive. Right. So that's not good for citizens. And as a government, they do not want to see this continue. So what they did was that they actually impose very strict regulations and measures to stop this thing from going on. That's why you can see a lot of because of Chinese government measures that impacted the whole property market. But is the government's intention to do that because they want China to be more sustainable in terms of the growth, in terms of what segment they want to be better at. So they want the Chinese economy to be, more high-end, generate and be driven by more highly value-added kind of activities. So directionally, it's actually correct, right? So, but of course, during this transition, that's where the impact that we are seeing. So during transition, definitely you will see this kind of economic impacts, right? It won't be it won't be smooth, right? So it's still something that everybody is watching. Question, just let me um next question. What do you think of REITs? How do you see it performing in your uh yeah, so I think I'll just give a general view about REITs, right? So uh I think so there's we are negative on the US REITs, especially the office side, but we are very positive on the Singapore REITs. So because Singapore REITs they are very much into logistic warehouse, which is very good. These are very good segments. And also, if you are at a peak of interest rate, then that is actually positive for REITs because higher rates, higher interest rate is actually bad for REITs. As long as we are at the peak already, then the REITs shouldn't be doing too the risk segment shouldn't face more pressure, you know. But generally, we don't have any risk in our portfolio. But also not giving an advice. But that is just a general kind of sense on what's going on with the REITs. Right. So next question is how you see currently, how do you see the technology fund? Is it too high to go in or should I cash out profit? Uh, 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 because this webinar is more for portfolios, so we don't. I'm not licensed to advise on individual fund. Yeah, but as you can see, we actually have strategic allocation in our tech, in tech and semicons. We still have it, so that actually will show you our positive stance on the segment, the tech segment. So next question is, have do I have to change my portfolio allocation like from aggressive to less aggressive as I'm approaching my target year for withdrawal? This you can refer to our CIS. Can just give us a call. Then they can advise you on that switch. Next questions. What about your views on US market? Should we invest more? Uh, yeah, so I think in our funds, you can see that we're actually neutral on US, right? So we're also neutral in Asia. We actually overweight Japan and we have strategic allocation in technology sector. Next question, Japan very high. I've already answered this. Um, then next question, um, what are the FSM China funds performance? What is the best time to invest in China? Oh, this one you can call us our CIS team. What is your benchmark for each portfolio, especially Islamic aggressive? Do you set any? Yeah, this is the benchmark is actually in our fact sheet. Yeah, so you can go through our fact sheet, or you can just call us if you can't find the fact sheet which has the benchmark. Yeah. So why do you pick J Qua ETF instead of other ETF, BO, QQQ? Yeah, so basically we have done our research and um, our discussion and our evaluation. So JQuai is actually better than those. Yeah. What is your expected return for this investment? We look at things on a portfolio basis. Yeah. So in terms of uh, having because this is actually the top selection for US exposure. So as long as we still have US exposure, that would be the fund that will represent the segment. Yeah. So when I redeem unit trust fund, it takes few days. How about managed portfolio? Yeah, you can call our CIS team, so they will be able to guide you through the process. Is it too late to start buying global semicon funds? You can call our CIS on this individual ETF. Yeah. Ignore these questions as these questions seem as above person. Thank you. What made SMH preferred to XOXX in the conventional portfolio? So our ETF selections is actually from our filtering process. So you can also contact our CIS to get more info on this. It should be also on our website that is our preferred pick for on our FSM website. So for every portfolio, do they have target return? Yes, every portfolio they do have target returns. So that is something that we aim to achieve. Yeah. So it's also on our fact sheet. So is it advisable to take profit when managed portfolio increase in price? So you can think about rebalancing, and you can definitely get in touch with us, our CIS team, to think about how to re-strategize your portfolio investment. If you want to, you can take profit and move into more conservative portfolio. So that is something to be matched against your risk profile. Yeah, do call us to check on that. It's now great timing to invest in China. You can call our CIS team to get a view on this on individual fund. Next question: when the Fed start to increase when the Fed start to cut interest rate, more dollar will flow out of US to Asia or emerging market. What is the possibility of China and Asia markets trending up and performing better than US? Yes, that's a good observation. So that has been a general kind of theoretical uh, thinking, is that when US Federal Reserve cut interest rate, that would actually uh, drive US dollar lower, and which in turn would help the emerging market like Asia, right? So yes, it's yet to see which market would benefit more from this scenario. Yeah, that is definitely has been happening in the past many years. So but it's not to say that US would do worse, because there are a lot of other factors. So Fed rate cut is just one of the many factors in the market. Next question, you mentioned to increase our investment when the market is low. How do we know when the market is low, as we are not expert? That's why we choose managed portfolio. Yep. So do do so that's why it's very important that we write this kind of money and quarterly commentary to give you a feel of what we think about the market. And the next thing is that come to our events. So in our events, we will let you get a very good feel about where we are now in the market phase. Yeah, because it's our mandate to stay invested all the time. We cannot raise cash, and what we want investors to go through is that stay with us throughout the whole cycle. And during the down market, investors should, when you see this kind of negative period, that is a very good time to investing much more. Yeah. So the other thing is that you can always call our CIS team, so they will give you some. Because our team is very up to date in terms of current market cycle, so we actually have a lot of avenues for investors to get in touch with us. Yeah. So next questions, under your portfolio, you have M China A fund. What is the reason China A is selected, and why M China A? Yeah, so we have our reasons in terms of the exposure of the fund, and we still feel that structurally the strategies for the fund is still very much intact with the direction of the Chinese government, right? So it's very important to be in the right segments that is at least in line with the government's direction. But if you look at our individual fact sheet, right, our China exposure is really small, right? So it's not a big concern. That's why you can see why even we have China exposure here, but our performance has been super amazing over the past 2023 and year to date. Right. So next question, do you think US will do more rate cutting because the inflation and job markets are still hot, even though they are coming down from the peak? So I think what I can say is that I'm not any better than the US Federal Reserve, the Jay Powell, or the governors, US central bank governors. I think they are super amazing. And from their forecast, is that they are expecting 3 rate cuts this year, 2024. Even from their, so even after January and February very hot inflation numbers, they are still expecting 3 rate cuts in the March meeting, which was just recently. So I'll just yeah, so that's what they say. Yeah. So I don't think I'm any better than them. So then so I think that actually answers your questions. So I think let's see whether it happens. Yeah. Yep. I think I have answered all the questions and also exceeded the time. So thank you so much, everybody. If anything, just contact us. Very happy to take your questions. Thank you.